Welcome to a short video on accounting for construction contracts. The key issue in relation to the accounting for construction contracts is when to recognize the revenues and expenses associated with that contract. The reason for this is that often the construction of major projects, such as Wembley Stadium in the UK or the Sydney Opera House, take many years, and determining A, how much profit is going to be made, and B, when that should occur, is open to interpretation if there was no accounting standard to deal with it. Without AASB 111, we could see companies recognizing all revenues and expenses in the last year of the project, or in the first year of the project, or even throughout the life of the project. So how does AASB 111 construction contracts deal with this? According to AASB 111 construction contracts, how a contract is accounted for is dependent on whether the stage of completion can be reliably measured. If it can be, paragraph 22 tells us to use that percentage as a way to recognize revenues and expenses. If the stage of completion cannot be reliably measured, then revenues and expenses can only be recognized to the extent of costs incurred according to paragraph 32. We'll look at each of these in turn. But before we do that, we need to know how to determine if the outcome is reliably measurable. For explanatory purposes, we're going to focus on fixed price contracts. Paragraph 23 provides us the conditions that must be satisfied to say the outcome is reliably measurable for such contracts. So, if the outcome is reliably measurable, as mentioned before, both revenue and costs are recognized based on the stage of completion, i.e., how much of the project has been completed. This can be measured in numerous ways. See paragraph 30. But to simplify, we will use cost. We now turn to an example. In this situation, we are 1 year into the project. We know we have spent $2 million, and we estimate that it is going to cost another $6 million to complete over the remaining 2 years. As such, the total estimated cost of this project is $8 million. Therefore, we have completed 25% of the project, which is calculated by the total cost to date of $2 million, divided by the estimated total cost of $8 million. As the contract price is $9 million, this is the amount we're going to receive from the client. Our total estimated profit is $1 million, the $9 million minus the $8 million in estimated total costs. And to wrap up the first year calculations, the profit that can be recognized in the first year is $250,000, which is 25% of $1 million. Because nothing has been recognized to date, this is the first year, all $250,000 can be shown as profit in year 1. Now, 1 year down the track, and in total we spent $7 million, which means $5 million was spent this year, with an estimated $1 million to complete. This means the estimated total costs remain at $8 million. The percentage complete to date is 87.5%, which is $7 million spent to date, divided by $8 million estimated total costs. As contract price and estimated total costs haven't changed, the estimated total profit remains at $1 million. Profit to date is therefore $875,000. However, we have already recognized $250,000, which means that in year 2, $625,000 is recognized. So the total of the 2 years gives $875,000. Now, you may be wondering why we just don't work out percentage complete in this particular year. For example, $5 million spent over $8 million gives you 62.5% complete, multiplied by the profit gives you $625,000. The reason we don't is that if costs change from estimates, this method won't work. And to finish off, the remaining $1 million is spent in year 3 and the project is finished, with $125,000 being recognized in the final year. And that finishes the calculations. Now turning to the debits and credits, we'll only look at the first year, as once you've got 1 year, the rest follow the same pattern. First, debit construction in progress and credit cash, however much was spent in building the project that year. The construction in progress is an asset account. Second, recognizing revenues and expenses. Debit construction expenses is easy and is simply the amount from the entry above. The debit construction in progress is the amount of profit previously determined. In this case, it is $250,000. The credit construction revenue is the balancing amount. Alternatively, you could multiply the percentage complete of 25% by the contract price of $9 million, which gives you $2.25 million. It's nice how everything works out. And that covers the situations where the stage of completion is reliably measurable. When the outcome is not reliably measurable, according to paragraph 32, you can only recognize revenue to the extent of costs incurred. This is a conservative option as it does not allow you to recognize any profit on the project until you have finished it. You don't need stage of completion in this instance, as A, you don't actually know it, and B, you don't actually use it. So turning back to the example, but in the situation where we don't know how much of the project we've completed. The first entry would be the same, but as no profit is recognized, the credit construction revenue can only be $2 million. There is no debit or credit to construction in progress. However, regardless of whether the outcome was reliably measurable or not, over the life of the project, the same total profit would be recognized. There are a couple of additional things to take note of. The first is that costs may not be as budgeted, i.e., whilst after 1 year it was expected that total costs were going to be $8 million, after 2 years it was expected that total costs were going to be 8.4. In that case, you need to make sure you adjust both A, the denominator used in the percentage complete calculation, so divided by 8.4, not 8, and B, the total expected profit is $600,000, not $1 million. The second thing to take note of is when a company anticipates it is going to make a loss on the project. If that happens, the full amount of the loss is immediately recognized, as noted in paragraph 36. This is regardless of the percentage complete, and it's also another example of conservative accounting at work. So, for example, with a contract price of $9 million and an expected total cost of $10 million after 1 year, the company expects to make a loss of $1 million. Even though the percentage complete is 20%, this is irrelevant. The first entry for this example is the same as normal, with a debit construction in progress and credit cash the amount of expenditure in that first year. For the second entry, the debit construction in progress is $2 million, the same as the first entry. However, a loss of $1 million is made on the project, so onerous liability is credited to reflect this loss. Construction revenue is credited whatever amount is required to make the entry balance. In this case, it's $1 million. In conclusion, the key points in accounting for a construction contract are: 1. Is the outcome reliably determined? If yes, then use percentage complete. If no, then only recognize revenue to the extent of costs incurred. 2. Costs don't necessarily have to be as budgeted. If they change, remember to adjust the denominator for the percentage complete calculation, and also the total estimated profit. And finally, 3. If a company expects a loss on the project, then the full loss is recognized immediately.